Susanna Desborough was a real estate agent. She helped families buy houses. She understood contracts, financing, the mechanics of ownership. In the fall of 1981, the average interest rate on a 30-year fixed mortgage hit 18.63%, the highest ever recorded in modern American history. That number is not the story. The story is the contract she signed before it arrived. On the outskirts of Los Angeles, in the San Fernando Valley, there is a place called Chatsworth. And in Chatsworth, in the summer of 1982, Susanna Desborough was losing her home. In the late 1970s, Susanna Desborough signed a popular kind of contract. It was called a balloon mortgage. You made monthly payments, but at the end of 2, 3, 4, or 5 years, the entire remaining balance came due in a single enormous payment. The balloon. The plan was to refinance before it arrived. That was the wager. By October 1981, that wager turned against her. If you had taken a balloon mortgage in the late 1970s, when rates were still manageable, you were now trying to refinance into a world where 18.63% was the new floor. Refinancing became extraordinarily difficult. The bank at the end of the balloon no longer offered rescue. It offered a locked door. 18.63. That number is verifiable. It is from the Freddie Mac Primary Mortgage Market Survey, week of October 9th, 1981. It is the highest 30-year fixed mortgage rate ever recorded in the United States. For the families who had signed balloon notes just a few years earlier, it meant one thing. Susanna Desborough's mortgage payment was $825 a month. She had fallen more than $10,000 behind. Valley Federal Savings and Loan Association held her mortgage. Valley Federal had begun the process of taking her house. They planned to sell it the next month. A savings and loan was created to lend to families. The institution that now held her mortgage was preparing to take it back. Susanna Desborough said this: "The situation became like a monster that kept growing." That is the only direct statement we have from her. It was recorded in a single article, published in Time magazine on August 2nd, 1982. She was a real estate agent. She sold homes for a living, and she was losing her own. Desborough was not alone. She was part of a wave. In the second half of 1981, lenders in California took possession of 7,163 homes. That was more than 3 times the number from the same period the year before. David Schulman was an economist at UCLA. He ran the Business Forecasting Project. He estimated that up to 8,000 residential properties could be foreclosed on in Los Angeles County in 1982. That would be a 175% increase over 1981. And he said this, also recorded in the same Time article: "This is only the beginning. It will get much worse." On the same block, or somewhere nearby, lived Francisco Cubillos. Cubillos was a Colombian immigrant. In March of 1982, a group of private investors began foreclosure proceedings against him. The reason? He had missed a single payment. $1,131. He was 17 days late. 17 days. In California in 1982, homeowners had a legal window of 90 days to catch up on delinquent payments once foreclosure proceedings began. Cubillos survived, but only after paying a $600 penalty on top of the missed installment. $600 for a 17-day delay. And then there was Craig Bowers. Bowers lived in Tarzana, a neighborhood adjacent to Chatsworth. He was a businessman, and he had a very different relationship to the foreclosure process. Bowers had survived 3 foreclosure actions in the past 2 years. When cash was short, he stopped paying the mortgage. When times improved, he resumed. He had done this 3 times. He still lived in his house. His strategy was summarized in a single line, also from the Time article. He said, "Foreclosure is a game." And then there was Mildred Todd. 15 years earlier, in approximately 1967, Todd had lost her own home to foreclosure. The same process that was now engulfing Desborough and Cubillos had already happened to her. But in 1982, she was not a victim. She was conducting seminars for Los Angeles area residents on how to prevent foreclosure. The cost to attend? $20. The scale of what was happening in California was not an anomaly. In the first quarter of 1982, the Mortgage Bankers Association reported that some 140,000 homes across the United States were in foreclosure proceedings. In California alone, nearly $500 million worth of balloon payment mortgages was coming due in 1982. Loans whose entire remaining principal was due at once. Don Martin was a senior executive at Security Pacific National Bank. When his institution processed foreclosures, they found a pattern. Many borrowers in foreclosure had not just one mortgage on their home, they had taken out second mortgages, third mortgages, even fourth mortgages. Martin also noted that the bank's current residential default rate had doubled compared to the previous year. The institutions holding these loans were bleeding too. Susanna Desborough sold houses. She showed them to families. She helped them with contracts, with financing, with the mechanics of buying a home. She understood the system from the inside, and she could not save herself. In California, the law gave homeowners a 90-day grace period once foreclosure proceedings began. It was a shield, a chance to catch up, but the window only worked if the money was available, if refinancing was possible, if the balloon had not already come due. For Desborough, the window was closing. Valley Federal planned to sell her home the next month. The exact date is not recorded. The outcome is not recorded. Francisco Cubillos paid. He survived the foreclosure. He paid the $1,131. He paid the $600 penalty. He kept his house. Craig Bowers survived 3 foreclosure actions. He paid when he could, stopped when he couldn't, and resumed when things improved. He had not lost his home. But he was living on the edge of loss, repeatedly. Behind every statistic, behind the 7,000 homes in California, behind the 140,000 homes nationally, there were families, children, movers, papers signed in courtrooms. You could see it on the streets. The signs appeared more frequently, the houses emptied, the lawns grew less tended. In Chatsworth, the calendar was running out for Susanna Desborough. Schulman's projection held 8,000 foreclosures in Los Angeles County, 175% higher than the year before. The wave he warned about had arrived. September 1982. The month Valley Federal planned to sell Susanna Desborough's house. Craig Bowers, meanwhile, was still in his house. His strategy was working. He had proved that the system could be gamed. All of this, the numbers, the penalties, the games, had a common root. A promise written in good faith, broken by a number no one could control. Susanna Desborough said this: "The situation became like a monster that kept growing. And the monster did not care that she sold houses for a living. It did not care that she understood the contract. It grew anyway." Mildred Todd lost her home in 1967.
15 years before the Time article was published. 15 years before Desborough's house went to auction. By 1982, Todd had not only survived, she had become a resource. She taught classes. She showed others what she had learned. Her seminars cost $20. That was what you paid to learn. From someone who had actually been through it, how to avoid the loss she had experienced. We do not know what happened to Susanna Desborough's house. The historical record offers no closure. That silence is not a flaw in the archive. It is the honest weight of the archive. She is one of thousands whose names we will never find on a final deed or a sheriff's sale. The monster did not just take homes. It swallowed the paper trail of entire families. 140,000 homes were in foreclosure proceedings in the first quarter of 1982. That is a national number. It includes California. It includes Florida. It includes Texas, New York, Illinois. But a proceeding was not always a loss. In California, the 90-day grace period gave many families a chance to catch up. Many found ways to survive the window. Cubillos did. Bowers did. Todd, after her loss, turned her experience into a lifeline for others. A central mechanism of the crisis was the contract itself. The balloon payment contract, written in the late 1970s, came due in a world where 18.63% made refinancing extraordinarily difficult. The rate was a condition. The contract was the trap. The structure of mortgage lending has evolved, but the underlying question remains: what happens when the terms of a contract become impossible to fulfill through no fault of the person who signed it? Francisco Cubillos missed a payment by 17 days. He had to pay $600 to get back on track. $600 for being 17 days late. Craig Bowers survived 3 foreclosures. Each survival came at a cost. Each survival was provisional. The system had not defeated him, but it had not stopped trying. Mildred Todd was not trying to game the system. She was teaching people how to survive it. She had learned the hard way 15 years earlier, when there was no one to teach her. What they faced was a structural trap. Desborough was a real estate agent. Cubillos was an immigrant who paid a $600 penalty just to stay. Todd had already lost a home 15 years earlier. None of them were warnings. They were evidence of what happens when a financial mechanism built for a stable world breaks in a volatile one. High interest rates alone do not destroy families. A contract that cannot be refinanced, combined with a rate that makes refinancing extraordinarily difficult, that is the trap. The contract does not bend to the world around it. In 1982, the world bent to 18.63%. The contract did not care.